Hello everyone, I'm Aaron Blake. Right now, a powerful shift is unfolding across global markets. Over the past 5 trading days alone, nearly $1.82 billion has been pulled out of US-based spot Bitcoin and Ether exchange-traded funds. This is happening as precious metals surged sharply, drawing attention and capital away from crypto products. This moment matters because ETF flows are one of the clearest real-time indicators of investor sentiment. And what we're seeing now signals a notable change in behavior that could shape how markets move next. Before we go further, subscribe right now, because what you're about to hear explains a shift most people still haven't noticed. Let me walk you through exactly what has happened, step by step, using only the confirmed data available. Over the last 5 trading days, from Monday through Friday, investors withdrew approximately $1.82 billion from US-based spot cryptocurrency ETFs. The majority of this came from Bitcoin products. According to data compiled by Farsight, spot Bitcoin ETFs alone recorded net outflows totaling about $1.49 billion during this period. At the same time, spot Ether ETFs experienced net outflows of $327.1 million. This development comes as the spot prices of both Bitcoin and Ether continued to weaken. Despite recent signs that suggested a possible recovery, prices moved lower. Over the past 7 days, Bitcoin declined by 6.55%, while Ether dropped by 8.99%. At the time of reporting, Bitcoin was trading at approximately $83,400, and Ether was trading near $2,685 based on data from CoinMarketCap. What stands out here is the timing. These sustained ETF outflows occurred even as there were brief moments of optimism in the crypto market. Bitcoin, for example, rose 7% over the 2 days leading up to January 15th. That short rally was driven by speculation surrounding the U.S. Clarity Act. However, the upward move did not last. The rally faded, and selling pressure returned soon after. During that same window, there was a notable spike in ETF inflows. On January 14th, Bitcoin ETFs recorded their highest single-day inflow of the year 2026, totaling $840.6 million. This surge happened just before a sharp shift in sentiment indicators. Shortly after, the Crypto Fear and Greed Index, which is widely used to measure overall market sentiment in the crypto space, climbed to its highest score of the year. The index reached a level of 61, placing it firmly in the category labeled as Greed. This sequence is important. ETF inflows peaked, sentiment indicators surged, and then, almost immediately, market conditions reversed. Prices declined, sentiment weakened, and capital began flowing out of crypto ETFs at a significant pace. Crypto market participants frequently monitor spot ETF flows because they provide insight into retail investor behavior. These flows are often used to gauge how confident or cautious investors are feeling, and they can offer clues about near-term price direction. In this case, the persistent outflows suggest growing caution among investors, particularly as other asset classes gained attention. One prominent voice addressing this shift is ETF analyst Eric Balchunas. He commented directly on the growing negativity surrounding Bitcoin's recent performance, especially when compared to gold and silver. Balchunas described this negative sentiment as very short-sighted. In a post shared on the social platform X on Saturday, Balchunas emphasized that Bitcoin had significantly outperformed many other assets in previous years. He pointed out that Bitcoin spanked everything so bad in 2023 and 2024, suggesting that recent comparisons overlook that context. Balchunas went further, noting that other assets have not yet fully caught up, even after experiencing what he described as their greatest year ever. He contrasted this with Bitcoin's current state, which he characterized as being in a coma. His remarks underscore the idea that short-term price action may not fully reflect longer-term performance patterns already observed. Balchunas also addressed the concept of institutional adoption. According to him, the so-called institutionalization narrative surrounding Bitcoin was priced into the market quickly. In his view, this happened ahead of the actual institutional participation taking place. As a result, he said Bitcoin needed to take a breather so that the underlying narrative could catch up with the price. While crypto ETFs were seeing heavy outflows, precious metals were making headlines of their own. Gold and silver both reached new all-time highs earlier in the week. Gold climbed to $5,608, while silver reached $121. However, volatility in metals was also evident. On Friday alone, gold fell 8%, dropping to $4,887. Silver experienced an even steeper decline, falling by around 27% to $84. These sharp moves highlight the intensity of recent market activity across asset classes. The metals rally, followed by sudden pullbacks, coincided with a period of heavy outflows from crypto ETFs. This overlap has drawn attention to how investors are reallocating capital during moments of uncertainty and heightened volatility. Adding to the discussion, Bitwise Chief Investment Officer Matt Hougan shared his perspective in a post on X dated January 15th. Hougan stated that Bitcoin's price will go parabolic. if ETF demand persists over the long term. His comment directly ties future price behavior to sustained interest in ETF products, emphasizing the role these vehicles play in shaping market dynamics. Now let me explain what this all means in practical terms. The past week has been defined by movement, not just in prices, but in investor behavior. When nearly $2 billion exits crypto ETFs in such a short period, it reflects a measurable shift in sentiment. This doesn't happen in isolation. It occurs alongside falling prices, changing narratives, and renewed attention on alternative assets like gold and silver. ETF flows matter because they represent aggregated decisions by a large number of investors. Each inflow or outflow is a signal. When those signals align over several days, they paint a clear picture of how confidence is evolving. In this case, the picture shows investors stepping back from crypto exposure, at least temporarily. At the same time, the data also shows how quickly sentiment can change. Just days before the outflows accelerated, Bitcoin ETFs experienced their strongest inflow day of the year. Sentiment indicators reached levels associated with optimism and greed, and yet the market reversed course shortly afterward. This rapid shift highlights the sensitivity of crypto markets to speculation, sentiment, and short-term developments. The brief rally tied to speculation about the U.S. Clarity Act illustrates how quickly prices can respond to perceived catalysts and how quickly those gains can disappear when momentum fades. The contrasting movements between crypto assets and precious metals during this period further underscore how investors are actively rotating capital. Gold and silver reaching record highs drew attention and investment, even though both metals later experienced sharp pullbacks. These moves occurred against the backdrop of weakening crypto prices and sustained ETF outflows. From a broader perspective, the comments from Eric Balchunas bring an additional layer of context. His remarks remind observers that recent underperformance does not erase prior periods of strong gains. By pointing out Bitcoin's performance in 2023 and 2024, he highlights how quickly narratives can shift when short-term trends dominate headlines. Balchunas' view on institutional adoption also frames the current period as a pause rather than a conclusion. According to his perspective, the market may be adjusting after pricing and expectations ahead of real-world developments. That adjustment, in his words, required Bitcoin to take a breather. Meanwhile, Matt Hougan's statement reinforces the idea that ETF demand remains central to the story. His comment directly links sustained ETF interest with dramatic price outcomes, emphasizing why flows into and out of these products are watched so closely. As we move toward a resolution, let's recap the confirmed facts. Over 5 trading days, about $1.82 billion was withdrawn from US-based spot Bitcoin and Ether ETFs. Bitcoin ETFs accounted for the majority of that figure with $1.49 billion in outflows, while Ether ETFs saw $327.1 million exit. These moves came as Bitcoin and Ether prices declined by 6.55% and 8.99% over 7 days. This all unfolded after a brief Bitcoin rally tied to speculation about the U.S. Clarity Act, a rally that quickly faded. It also followed the strongest single-day Bitcoin ETF inflow of 2026 on January 14th, and a surge in the Crypto Fear and Greed Index to a greed reading of 61. At the same time, gold and silver hit all-time highs before experiencing sharp declines, highlighting the volatility and shifting focus across markets. Analysts and industry figures weighed in, describing current negativity as short-sighted and emphasizing the role of ETF demand in shaping long-term outcomes. This situation matters because it shows how quickly sentiment, capital flows, and narratives can change. It demonstrates the interconnected nature of markets and the importance of tracking confirmed data rather than assumptions. Thanks for watching. Subscribe, share this video, and stay alert, because what's happening right now matters more than most people realize.